Welcome to vTalkInsight, Risk Sentiment Daily for December 12, 2025. Liquidity from the Federal Reserve, booming AI investment, and late-cycle fragilities are pulling markets in different directions today, making it a crucial moment to reassess how durable this risk-on backdrop really is. Across assets, today's picture is best described as cautiously risk-on in a clearly late-cycle setting. Major U.S. equity indices are at or near record highs. Recent pullbacks have been shallow and quickly bought, and the volatility index has drifted lower, all pointing to investors still willing to embrace risk despite mounting concerns. Supporting this tone, the Federal Reserve has delivered a third consecutive quarter-point rate cut and surprised markets with sizable Treasury bill purchases, moves that together signal easier financial conditions even as the official guidance on future cuts turns more cautious. At the same time, the Fed has nudged its growth forecasts higher and inflation expectations lower, and broader commentary highlights that key macro cycles, growth, inflation, monetary policy, fiscal policy, and liquidity, are currently aligned in a way that historically favors risk assets. Under the surface, however, the tone is less straightforward. Oracle's earnings miss, heavy AI-related capital spending, and rising credit default swap costs have triggered a sharp sell-off in the stock and weakness in the broader AI complex, while concerns over stretched equity valuations and tight credit spreads point to growing vulnerability if the macro narrative stumbles. Labor market signals are also turning noisier, with downward payroll revisions and softer hiring trends prompting the Fed to cite increased downside risks to employment, even as consumer spending and holiday sales remain resilient. Taken together, markets are leaning into the supportive policy and growth story, but do so with one eye firmly on AI-related concentration, private credit risks, and late-cycle macro fragilities, which keeps the overall tone cautiously, rather than aggressively, risk-on. Fed easing and liquidity backstops remain a central bullish driver for risk sentiment. The central bank has just delivered a third straight quarter-point cut, but now signals only one further cut likely next year, a message that sounds cautious on the surface, yet is paired with a powerful expansion of balance sheet support. The decision to start buying up to $40 billion in Treasury bills, exceeding expectations, is being widely interpreted as quasi-quantitative easing rather than mere technical reserve management. Front-end Treasuries rallied on the announcement, and recent bond buying to address funding pressures suggests the Fed is prepared to intervene aggressively in money markets, reducing the risk of a liquidity crunch early next year. This policy mix, rate cuts, balance sheet expansion, and a stated willingness to prioritize employment over inflation, creates a supportive backdrop for both risk assets and fixed income carry, especially as central banks more broadly are expected to lean dovish if credit stress emerges. That said, internal FOMC division, political noise around the next Fed chair, and tariff-driven inflation risks all mean the path of easing is far from guaranteed, so investors are rewarding assets that benefit from liquidity support while remaining sensitive to any hint that the backstop might weaken. AI-driven productivity and earnings momentum are another major prop for today's risk-on tone. Expectations are building that generative AI could lift U.S. productivity growth by around 0.5 percentage point over the next several years, allowing the economy to expand near 2% without adding labor hours and helping the Fed reconcile decent growth with ongoing rate cuts. On the ground, enterprise adoption is broadening, with large companies across finance, healthcare, energy, and consumer sectors reporting tangible productivity gains and stronger backlogs tied to AI projects. Chip and infrastructure suppliers such as Broadcom are guiding to AI-related revenues doubling year over year, while deals like Disney's billion-dollar investment and licensing partnership with OpenAI highlight how AI is opening new, high-margin revenue streams for content owners. This story underpins bullish earnings forecasts into 2026 and supports the view that an AI-led capex boom can sustain growth even as the cycle matures, but it is not without caveats. Only a minority of firms are yet realizing strong AI returns. Surveys still assign a modest probability to a full productivity regime shift, and the sector's leadership increasingly depends on a handful of projects and counterparties, meaning that any setback in AI monetization could quickly challenge today's optimism. A broadening risk-on rotation in assets is reinforcing the constructive sentiment beyond the AI leaders. Recent sessions have seen record or near-record closes in the S&P 500, Dow, and Russell 2000, even as the Nasdaq lags, reflecting a shift in leadership away from the largest mega-cap tech names towards sectors such as financials, materials, healthcare, and higher-quality small caps. Small caps are approaching all-time highs, supported by lower rates and fiscal relief, and there is evidence of a broad equity overweight across large, mid, and small caps. At the same time, commodities are gaining traction, with the main commodity index moving above its 200-day average and gold and silver breaking higher, helping lift mining shares and signaling renewed interest in real assets as both growth and policy hedges. Retail flows add to this picture, with allocations running well above recent averages and corrections being shallow and quickly bought, suggesting meaningful liquidity on the sidelines. Still, the recent surge in high-beta cyclicals and smaller stocks looks increasingly aggressive, and with year-end liquidity thinning and macro uncertainty unresolved, segments that have run hardest may be vulnerable if incoming data fail to validate the optimistic narrative. Offsetting these bullish forces, AI and equity valuation risks are becoming harder to ignore. The S&P 500 is trading at an elevated price-to-earnings ratio versus history, implying that long-term equity returns may be constrained to low single digits, while AI-exposed stocks in particular embed revenue and profit expectations that some analysts argue could exceed entire global industry revenue pools. Oracle's latest results have crystallized many of these concerns. The company reported disappointing cloud sales, sharply negative free cash flow, and a debt load above $100 billion, raising questions about whether its heavy AI infrastructure spending can generate sufficient returns. Credit markets have reacted with credit default swaps spiking to their highest levels since 2009 and the equity dropping around 11%, dragging broader AI sentiment lower. More broadly, doubts are emerging about whether simply scaling large language models will keep delivering proportionate gains, and several key AI projects and chip demand trajectories hinge on a narrow set of customers and use cases. When combined with signs of extreme optimism in names like Broadcom and growing talk of an AI capex bubble, this concentration of expectations leaves the equity market sensitive to any disappointment in AI adoption, profitability, or funding conditions. Growing private and credit vulnerabilities form another important bearish undercurrent. Investor positioning in U.S. credit is at its highest in about 15 years, with spreads near historic tights, signaling limited compensation for risk at a time when the cycle is already advanced. In private credit, the buildup is even more striking. Funds now show substantial exposure to technology borrowers, including AI-related names, with high leverage, tight spreads, and significant insurer participation, all in a market that has not been tested by a full credit cycle, raising the risk of contagion if defaults rise or growth falters. On the surface, scarcity of net new investment grade and high-yield issuance and an improvement in overall high-yield quality help to justify tight spreads and have supported carry strategies so far. But growing regulatory scrutiny of private credit structures, rising costs of credit protection for specific issuers, and the prospect of a large AI capex funding wave suggest that credit could shift from being a stabilizer to a transmission channel for shocks, particularly if fundamentals disappoint. Softening labor and late-cycle fragilities round out the main set of headwinds. Recent Fed communication makes clear that the latest rate cuts were driven more by concerns over labor market weakness and downside risks to employment than by comfort with the inflation outlook, with revised payroll data pointing to little or no net job growth over the past 6 months. At the same time, upward pressure on consumer prices from tariffs is expected to persist into the first quarter, and trade barriers are cited as a key reason why rates cannot fall more quickly. Wholesale inventories have risen even as sales have softened, hinting at potential demand fatigue, while new tariff actions from Mexico and ongoing U.S.-China chip frictions underscore a stickier, more fragmented trade environment. These dynamics leave the Fed in a difficult position. It aims to support employment and has revised growth forecasts higher, yet faces internal division, political scrutiny over its independence, and the risk that inflation stays uncomfortably above target if tariffs and services prices remain firm. For markets, that combination of softer but not collapsing labor data, lingering inflation forces, and policy uncertainty reinforces the sense of a late-cycle expansion where the upside from additional multiple re-rating is limited and the sensitivity to negative surprises is increasing. To sum up, today's risk sentiment remains cautiously risk-on, powered by Fed easing and liquidity support, an AI-driven productivity and earnings story, and a broadening rotation into cyclicals, small caps, and real assets. Set against that are stretched AI and equity valuations, growing private credit and broader credit vulnerabilities, and late-cycle labor and tariff dynamics that leave the expansion more fragile than headline indices suggest. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.